So a few of the myths that we commonly hear here are you cannot use cost segregations on residential rentals. You definitely can use them on residential rentals. Welcome back in, everyone, to REI Tax University here, where we talk all things tax planning for real estate investors. And we are deep in the weeds of depreciation in our series here. And today we're going to get into one of my favorite topics, cost segregation. This is a pretty complex topic and one that is misunderstood by many real estate investors and even many accountants and CPAs that we found. So we want to take some time today to just explain what the cost segregation is, how and when it could make sense, and also to bust some of the common myths out there and things that you may have heard from others. And as always, we love anyone who wants to watch along on the video with us throughout, but if you're someone who just wants to stick your phone in your pocket, minimize the screen, throw in your AirPods, and go for a walk or do something you enjoy, we'll be sure to let you know if you need to watch anything on the screen. So cost segregations, or what you may hear me or others shorten to cost segs. What are these magical tax planning tools? If you've been following along in our series here on depreciation, then you know at this point that building structures and building improvements on those long-term rentals, short-term rentals, and commercial properties, those cannot be bonus depreciated. Meaning for the long-term rentals, or 39 years, bonus depreciated, meaning those have to be straight line depreciated over 27 and a half years for the short-term rentals and the commercial properties. And taking that straight line depreciation on the properties and the purchase price of the property, that may be fine for many of you, but some of you may want to go to that next level. You may say, hey, I want some more advantages from this and I want to do some more and get some more up front. That's when you may implement something called a cost segregation study. So a cost segregation study is an engineering study in which they go into one of the buildings and they break things up so that instead of that whole purchase price being allocated to the land and your building at either 27 and a half years or 39 years, the building piece is broken down into things that qualify for 5-year property classification, 7-year property classification, and 15-year property classification. And then the remaining portion is left in the 27 and a half year or the 39-year property. So what this means is that when you bought that property for $450,000, they determined that $100,000 was paid for the land and that $350,000 was paid for the building. But you didn't pay $350,000 just for the structure. There's other things that are a part of that building. There's components that make up that building. And those are all things that were included in that $350,000 purchase price. Those are things like flooring, cabinets, fences, ceiling fans, driveways, decks. All these items are things that may or may not be able to be broken out into 5-year, 7-year, or 15-year property that's included in 27 and a half year or 39-year property. But how can you know how these components would be broken out and what amount to allocate to each? You can't. You have to utilize a cost segregation study in which an engineering firm will give you a report that breaks it all out for you and assigns value to each classification of property. Once we, as the CPAs, have this report in hand from the engineering firm, we can then look at those properties, decide what we want to take bonus depreciation on the portions that have been broken out into 5-year, 7-year, and 15-year property, and increase your depreciation and your bonus depreciation amount, increase your losses from your real estate, and then utilize those to offset your income and get you tax savings. So you'll note that when we talked about in our prior examples that you would get $12,700 in depreciation expense each year from the $350,000 building, that's pretty good. And that's taking that building on a straight line basis. But let's say on that same building, you decided to implement a cost segregation study. What might that look like? Well, you don't have to get too hung up on the numbers we're going to use in this example, but if you want to follow along and write them down, feel free to. We're going to assume that the engineering firm gives you this report and it looks like this. 5-year property, $60,000. 7-year property, $5,000. 15-year property, $22,500. Your 27 and a half year building, $262,500. And finally, your land of $100,000. Now you'll note that if you add all those up, those get back to your full property value of $450,000. They're just now in 5 different columns instead of being in the 2, land and building. So why would you want to do this? Well, in our prior example, when we just had the land and the building, your depreciation expense each year was $12,700. But if we do this, I now have a report with assets that are 5 years, 7 years, and 15 years that total up to $87,500. Those are all items which I can determine if we want to take bonus depreciation on. So go ahead and take a look at the screen now as we throw up an example of what this could look like in a real life example on your P&L statement and from a tax deduction standpoint. Okay, so in our first P&L example here that you'll see on the screen, we're assuming that you didn't do the cost segregation study. You just left things as they were. You had the building for $350 and your land for $100, and it's year one, and you took depreciation expense on the building, straight line, and it was $12,700. So you'll note your depreciation expense, that's the yellow highlighted line for $12,700. That's gonna put your net income at a loss of $8,700, and your tax savings on that is just a little bit over $2,000. So at least you're not paying any taxes on the real estate investments. You've made some money off of it, but on paper you have a loss, and you've got that loss of $2,000 that hopefully you're able to take to offset your other income. But now let's move over to an example of what happens when we utilize the cost segregation study and we fully leverage bonus depreciation in this example. So you'll note here that instead of your depreciation expense being $12,700, it's $60,700. Well, how is that possible? Remember that $87,500, we can take 60% of it right away. Everything else that's left, whatever the 5-year stuff was, so the 40% that's left there, we divide that by 5 years. The 7-year stuff, what's left there, the 40% of it, we divide by 7. And the 15-year stuff, it was 22.5, and we took 60% up front, but the rest of it we divide by 15. So all of that's still better than when we had to divide it over 27.5 years. And we still have that piece that's the building, which just went from 350 to 262.5. So now we take 262.5 divided by 27.5. So if you're following along at home, if you want to do all the calculations, you'll add all of that up and you'll see how we get to depreciation of the $67,700. So what this does is this takes your loss from $8,700 to a net loss of $63,700. Now, assuming, as in the above example, that you're at an average tax rate of 25%, the real tax savings here is almost $16,000. So by utilizing the cost segregation study here, you've increased your real tax savings, the real money to you this year, by $14,000. All right, so hopefully you guys were able to follow along with that example and see the power of the leverage that cost segregations can have, especially when you effectively implement the bonus depreciation that they can give you. Now, keep in mind that you're going to want to know, are you able to use those losses? Do you have passive income you offset, or do you meet real estate professional status, or is it a short-term rental and you materially participate? Like, you're going to want to make sure you can use those losses, which is why you want to use an engineering firm. You want to use an accountant that works with an engineering firm to do that. That's what we do. We help to kind of coordinate that relationship with the engineering firm and quarterback the whole thing. But also that accountant's going to be able to tell you, okay, this loss is worth it because we can use it over here. We can accelerate and take this loss and we can use it this year, right? So keep that in mind, because these can be really powerful tools, but they're definitely situational, and you want to make sure they're going to work for you and you're going to be able to use those losses that you create. Now, we hear a lot of things about cost segregations, whether it comes from someone's accountant or another real estate investor or their neighbor next door. And I just want to take a couple seconds here and debunk a few of the common myths that we hear surrounding cost segregation studies. Now, I will back this by saying they're not meant for everyone. You do want to work with a qualified accountant and someone that really understands real estate as you do these, and you want to make sure that you're working with a strong engineering firm, or at least the accountant has a good partnership with that engineering firm. But they are very useful when implemented correctly. So a few of the myths that we commonly hear here are you cannot use cost segregations on residential rentals. You definitely can use them on residential rentals. Many people think of cost segregations as these big studies that cost a lot of money, and there is a significant cost to that. We'll get into that in the next half myth. But for this one, just know you can use them on residential rentals. You can use them on short terms. You can use them on commercial rentals. Now, the next kind of half myth that I hear is that these cost segregation studies aren't feasible from a cost standpoint to the taxpayer. And at times that is true, but oftentimes it's actually not true. But accountants and others, they don't always understand all the options that are available to the taxpayer from the cost segregation study. Many accountants and others, they view cost segregations as these high cost items that you have to pay to have the engineer come into a property and do the study, and it's going to be 10 to 20 grand. And that's true. That is one level of a cost segregation study. And for that to make sense, you need to have enough tax savings from the depreciation to make it make sense, because why would you pay 10 grand if you're only going to get $10,000 of tax savings? It doesn't make sense to do it. But there are other levels of cost segregation studies that the engineering firms are able to do. There are three main levels. There's a paper study, there's an engineering study, and there's a full in-person study. And depending on the property type and the full cost of the property and the renovations that have been done, that will help determine which level of a cost segregation study you need. And that also determines what cost you have to pay to have the study done. So you can definitely do this. And I see it done for $1,000 on a study to $3,000 to $5,000. And then I see the ones that are upwards of $7.5 to 20 grand that they have to really come in and do the full study. Now, what your CPA's role should be here, there are some accountants out there that are qualified to do cost segregations. They're few and far between. I only know of about one currently. There may be some others that are doing them, but to really do it, you're probably going to want to use an engineering firm. As an accountant, I don't know how a building is put together or how to assign values to that building. The engineers are the ones who know how to do that. So as the CPAs, what we do is we're the quarterback. So when someone comes to us, we are the ones to tell them, hey, this looks like it could be right for a cost segregation. This might be the level of cost segregation you want to go to based on the kind of property this is, the value that it's at, or we can tell them, hey, this is under $100,000, even $150,000. The cost segregation is just not going to make sense for you. Once we've determined it could make sense, that's when we're going to go talk to our engineer and get a couple quotes on how much would this cost and what would be the potential estimated tax savings on the breakout from this. What would a breakout look like? And then we can help determine that tax savings for the taxpayer. And that way we can tell them, hey, this is something you should do. Here's the cost. Here's our estimated tax savings, and let's implement it. And they know they're working with a qualified engineering firm that we've worked with previously and that we trust and that has IRS approval to run these cost segregation studies. Guys, as always, I really appreciate you tuning in, and I hope you found some valuable content out of this video. If you did, please like and subscribe to our channel here. Also, jump over to reitaxu.com. That's our community where we talk about everything real estate tax planning centric. So if this is stuff that interests you, definitely join our community over there. It'll definitely be worthwhile to you. And be sure to catch the rest of our videos here on our series on depreciation. And the next one, we're going to get into the potential pitfalls and what to consider when it comes to depreciation when you're going to sell a property.